G'day traders, Stacey Burke from Stacey Burke Trading. Today talking about making money on the trades or the days that it is easy to make money on. And a lot of traders have asked me, emailing me, what my best trade setups are, what I consider to be my scalable trade setups. So today we're going to go over and review that process. And just before we do that, I want to touch base and talk about a simple explanation that Peter Brandt has written in one of his books about why markets exist and the one reason why they exist, and that is that the sole purpose for the existence of capital markets is to reallocate wealth from the many to the few. This is the primary function of markets, whether economists want to admit it or not. If this function is not satisfied, the markets would cease to exist as we know them. Since that is the reality, to be successful, you must align yourself with a few rather than the many. You've heard me talk about Peter Brandt before. He's had a huge influence on my trading. He's been trading for 40 plus years, a wealth of knowledge and experience. But the simple concepts, Peter trades mostly weekly, daily charts, monthly charts, longer time frame, classical charting, but the same principles apply whether you're trading intraday, daily, whatever that may be. The same principles apply. And that principle is basically, it's a zero-sum game. If you're trading leveraged markets, zero-sum trading. Somebody has to lose in order for somebody to win. And so coming to our next topic today is, do you know what your best trade setups are? So there's trades that happen every single day, and I talk about mainly myself focusing on the highs and lows, session opportunities for 25, 50, 75 pip moves or more, but the bread and butter trades, the big trades, the trades that are scalable and duplicatable, for me are the trades that come off the high and the low of the day at session timings after they've set the high and the low, and they offer asymmetrical risk reward of maybe minimum of 5, maybe 10 plus. Gold obviously can move a couple of hundred pips in a session. And an example from yesterday, Monday, a fantastic opportunity, a second day trade coming off of Friday's big move. But just, again, the simplicity of working from the high and the low. Now this is an example of a market that set up over the 3 sessions. And again, engulfments, pin hammers. People ask me, what do you mean by a pin hammer engulfment? Now, I am mainly only looking for pin hammers at the highs and the lows. Now, on different time frames, I will use different time frame charts to look for that entry. So I'm not looking for different time frame trades. I'm not looking for trend confirmations. I'm looking at the price levels of the high and the low, the previous day's highs or lows, the weekly highs and lows. That is the most critical area for me. Everything else inside is inside. And again, understanding the concept of volume getting trapped. Now, not every day is going to be as simple as this, where they make a low, they make a high, they come back down to the low, the previous day's high, which was a weekly high as well, and give us our pin hammer after 1 push, 2 push, 3 pushes down the beginning of the new 4-hour block off of 50. And on a smaller time frame, we had a W on the 1 minute and a 5 minute bull pin hammer as well. But I'm only showing this as an example of understanding asymmetrical risk reward. We have a high and a low that creates a geometrical rectangular structure for a measured move, one full expansion of that range. And again, just the simplicity of understanding that each session will create a high or a low or potentially be inside. But over the 3 sessions, we'll have a high and a low, and we have the opportunity potentially for a move, a measured move, a trend trade, a reversal trade. So my best trade setups are the ones that typically will set up at a daily high or low, but involve the weekly high-low range. So again, with gold, we could be looking at a 300 pip high-low for a weekly range. On the other major pairs, it may be 150 pips. We're not going to go too deep into 3 levels of rise and fall in this, but just the concept of knowing that my best risk reward setups are usually high of the week, low of the week opportunities. Now, the next thing that we're going to talk about is understanding the types of trades that they are. The types of trades that I'm looking for, as we saw back on the previous slide, are ones that when they go, they don't come back. We're not caught in a market, even though this market dropped down 75 pips, it was grinding down, grinding down, grinding down. The setups that I'm looking for are exactly this, the creeping trend down that explodes and doesn't come back, because I'm looking for the opportunity of where I can put size on. And I don't want a lot of stress. I want to have a high probability that it's not only is it going to move, but it's going to move very fast and not come back. The reason why it's not going to come back is because if it comes back inside, it allows traders that potentially are underwater, they're losing money or they've lost money, to get out at either break even or with a smaller loss. So again, coming back to understanding zero-sum trading, somebody has to lose. And in order for somebody to win, somebody has to lose. And that rapid, explosive trade is exactly that. It's moving quickly to hit stops, but also trap volume, catch traders off guard that maybe are holding on for more money, they haven't taken profits. It's also potentially going to trigger other buy stops on the way up, where traders have been trailing the move with stop orders. Just a lot of, again, momentum that is not going to come back. So the other concept to grasp is that each session, each day, each week, each month, and we'll talk about that as well, there's a 3-day cycle. So Monday, Tuesday, Wednesday, typically Monday, Tuesday will set a high-low for the week. And that third day, depending on where we're at in the weekly structure, in the monthly structure, that third day may be a full move day to one of the extremes, which again by that point we have end of day traders in, potentially weekly traders in, because a weekly level may have been broken. If we're inside of a previous week's high-low, we may now be working off of one of the extremes that Monday, Tuesday has set, and we'll look at some examples of that. But that third day is where we often will get our day zero, our narrow range day, or a Wednesday, Thursday, for an explosive move on the Thursday, or a reversal trade on the Friday, or if we're into a second day trade, as we saw on gold, or last week we could get payrolls on a Friday. Monday may continue a move, or a Fed move may continue into the next day. We may get that reversal day or that narrow range day on a Friday, Monday. But when Monday starts, Monday, Tuesday, Wednesday, we have that opportunity for that fast, explosive move setting up as well for a high of week, low of week trade opportunity. So again, just understanding the average weekly range and then targeting asymmetrical risk reward. So I know there are traders out there who want to target 10 pips and they're going to risk 10 to get 10, and they want to take, 40 pips or 50 pips a week total, or whatever, 20 pips a day. What I'm looking for, again, if we go back and understand the rationale and the psychology behind these types of setups, is that I want them to be the explosive, fast moves that aren't coming back, because this is how, again, coming back to what we talked about on the first slide, I want to make money on the days and the setups that it's easy to make money on. So if you grasp that concept, the explosive, fast, stop hunt move, then you'll know that those are the scalable trade setups that I'm looking to put sizing on. The other trades that are in during the day, during the session timings, for the most part, most of those will be just bread and butter trade opportunities where you're going to target 25, 50 pips, depending on the instrument and the pair, the volatility. But you're, usually risking 10, 12, 15 pips on those, and they're probably going to move 50 pips. The same concept on a smaller time frame, but then we get the other trade setups that are potentially our real money makers, which are our high of the week, low of the week opportunities, and we'll talk about some of the monthly setups as well. So again, the 3-session cycle, setting a high and a low for the day. So Asia, London, New York. Often Asia can set a high or a low. London can do the same. They may consolidate it inside. Then the U.S. session, as we saw on that previous example, can explode and give us a continuation move, a reversal trade, or just a trading range trade setup opportunity, but again, targeting the entire average daily range. So we've talked about this in previous videos. Entries are pin hammers and engulfments at the high or the low in the 12. Typically, they'll be in the 12 candle window. Not always. So the next thing to understand is that if that trade doesn't happen in that window, then again, coming back to where are we at in that weekly cycle, the bigger opportunity may still not have presented, as we still may be expanding the range or establishing the high or the low. It may not be in place yet. So the market may move outside of the normal hours, and it still may be establishing or trapping volume up high or down low for a larger move or reversal for later in the week. So because you see something has moved doesn't necessarily mean that you've missed out. That may be part of an upcoming move, again, where they're dragging volume in one direction before they're going to reverse the market and give you another fantastic opportunity for another trade. So I will enter on any time frame that confirms my entry criteria at that high or low level. So I'll have an hourly chart or a 15-minute chart, but what I'm looking at with those are where are the highs and lows. So taking a step back, and rather than just having a 1-minute chart on there and looking for the highs and lows, I use the hourly and the 15-minute, 5-minute, and 1-minute. I'm looking for my major high-low levels. Then in the timing windows, I want to see stops get hit for a continuation trade, a reversal trade, and again, I'm looking for that level. In most days, I'm only working from the previous day's highs or lows. Now, we may have broken one of those levels or a weekly level, and then we've established a new high-low. So again, we could be in a trend trade off of the current high-low, as we saw in the gold example from yesterday. Or we may be inside of a previous day's high and low, and again, we may be inside of those, and I can expect to see potentially a stop hunt to a previous day's higher low or a higher low put inside of one of those peak formations. So let's take a look at the euro, for example. Just an example, last week we had our Monday, Tuesday, Friday was payrolls. They brought the market up. Monday made a high and a low. Tuesday they extended, they tapped into the Monday's low, so they went up 3 pushes. On Monday, they made a high. Then they had 3 pushes on Tuesday to make a low. They dropped down on the Wednesday. So again, this is an example of where, obviously there was news on the U.S. session on the Wednesday. When I see a market run away like this, people think, we missed a move. How would you have traded that? All those things. I'm not looking at that. I'm looking at the high and the low of the week. And then what I'm looking for is my day zero, or a high of the week, low of the week trade setup opportunity. Now on the Thursday, the market made a peak formation high and a peak formation low at the bottom of the week. They came back inside of that and went into consolidation. This is an opportunity for an explosive move. This happens on our daily charts. This happens on our hourly and 15-minute charts. We see these setups all the time. This narrow range day consolidation, peak formation, and then consolidation inside of the peak formations is a dead giveaway for an explosive trade opportunity. Now, sometimes we can see the same pattern for a continuation of that trend. This was a reversal setup opportunity. We had the 1, 2, 3 down and the engulfments in the Asian session off of the quarter level for the explosive 75 pip move back up. So again, coming back to the understanding of the type of trade that it is. It's a trade that's going to move and not come back. So yes, there are other trades where you could have sold high and the market fell 75 pips. I'm looking for a trade that's going to explode and move and be an always in trade setup, as Al Brooks called them. Always in long, always in short. They don't come back. Anybody who counter trends them gets smashed. And these are the days that you want to be in the market. And for me, those are the opportunities where I'm comfortable putting size on because the market just keeps punching and going further and further and further. Comes back for a bar, goes again, and hits it again. It just keeps going. So, an example of a high of the week, low of the week setup on gold. Last week, we had 3 days working the high on gold. You'll notice again the wicks. So there's a pin hammer at the high of the week at the beginning of the U.S. equity hour on the Wednesday, and they dropped that market down 250 pips. Traders think they've missed the move. They're looking to short that big move, and they want to continue shorting this. The market has triggered the previous day's low. Now we have end-of-day traders in. You'll notice that this market closed down at its extreme, so it closed below a bull pin bar on the daily chart, which again would attract other time frame traders into the market. They immediately stop hunt back up into traders that are short at the previous day's low. They create a low, they create a high, they stop hunt back into the peak formation and into the London session for a 50 pip, 100 pip move down, taking out the low of the week. So now not only have we gotten the previous day's end of day traders triggered into the market, we've now got traders trading the break of that daily level, but also the low of our week. And then we get our 1, 2, 3 engulfment pin hammer reversal. Now on a smaller time frame, this gave a beautiful consolidation on a 1 minute chart with a bursting 1, 2, 3 on the 1 minute below the double zeros, and immediately pulled back above into consolidation. But understanding though, we had lower highs down low, which again creates our geometry for structure. So we've got a rectangle, a smaller pattern within a pattern, down at the bottom of our weekly range. This is Thursday, day 4, at the low of the week. And again, then monitoring, well, how does price behave once we're in the trade? How does it behave? It comes right back in fast and aggressive, as it should, if this market is going to go back to the high. Now, the market could have came up to the high and failed. So the market at the low of a week gives us our trade opportunity, goes right back to the high of the day, but then layers on top of that into the close. So there are two opportunities here. We've got the first trade that comes back through the high of the day. So low of the week, high of the day. High of the week, low of the day. Get those concepts into your head. The first place they're going to stop hunt back to, if it's the low of the week, is the high of the day, and vice versa. But the next day gave us a second day trade opportunity. And again, if you study the Asian range in gold, you'll see the 75 pip high-low is almost a textbook consistent pattern. They dropped it 75 pips from the high. They hit the stops on the last swing low on top of the break of the previous day's high at double zeros, went sideways in our timing window. So again, an hour and a half down, engulfment sideways, a breakout pullback, and then a engulfment above for our little reversal head and shoulders pattern, and an explosive 100 pip move straight up. So again, these are explosive moves, and these are the types of trades. So coming back to where that move originated, the stop hunt goes back right away to get those traders at least at break even. And this is the type of opportunities that for me are scalable. We get lower highs, creeping trends, low of the week, high of the week opportunities. This, obviously, if you've been following gold, you see that this has continued and moved high to low 400 pips into Friday's close, and has continued since then. So just coming back to understanding, this is not hindsight trading. Okay, we're going to have a 1, 2, 3, a Monday, Tuesday, Wednesday opportunity this week. We're going to have an Asia, London, New York opportunity today. We're going to have a high and a low opportunity today. We're going to have a high and a low opportunity for the week. We're going to have trend trades, reversal trades, and trading range opportunities. So the timing windows they show up. They do the same things every single day. You're either at the high or you're at the low. If you're inside, understand They will be going back to one of those extremes. That's how these markets work. Let's go back and understand one more time. Markets exist for one reason: to transfer money from the many to the few. So when I see people talk about hindsight trading, and they want to see it in live time, let me emphasize this: you're at the high or the low, or you aren't. It doesn't matter what day it is. It doesn't matter what session it is. So if you're not there and you're inside, or you're inside of yesterday's high and low, I wait, because it come back to what we just talked about. I'm looking for trade setups that are going to explode and move hard and fast. If I'm inside and I'm not at a high or a low, chances are I'm in the trap. I'm trapped volume. Now, there may be a move. There may be a move after we've set the high and the low, as we see here, back to the extreme. But they've hit the weekly low. They've hit the stops. So understand this. Once other time frame traders are triggered into the market, remember this: nobody gets a free lunch. So when somebody's entered in at the low of the week and they've sold that at the low of the week after a 300 pip move down, and by the way, this was an up move on the daily trend, but up move, down move, but this was also the low of Friday's bar. Friday's entire range was the week. Friday, the payroll's Friday, the high and the low. They went up to the high of Friday, and they went down to the low of Friday. That's all it was. 3 days down. 1, 2, 3. 3 lower lows. Hit the stops. Pattern within a pattern. Geometry, 1, 2, 3. Engulfment pin hammer. Price behaves as it should. Then the next day we get a second day opportunity with a scalable trade setup. Now, we haven't talked a lot about this, the end of day stuff, but the same cycles and patterns happen on the daily charts every month. So we have a monthly high and a low. Every month is going to be different depending on where we're at. We may be up high, we may be inside. My trigger for any trades off the day, just understand this: if you can combine a monthly, weekly, daily, and session level opportunity with engulfment pin hammer for a larger move at the high or the low of the month, at the beginning of a move, weekly level, Monday, Tuesday, Wednesday, all that stuff. Now you're talking a 2-3 day move, which on gold could be 500, 600, 700 pips. On some of the majors, maybe 150 pips. But there are moves that are not going to come back. Again, understand the same rules apply. Somebody's in the money heading into the end of the month. There's a big, strong move down. Now the new month starts. We're inside. So what do? Well, what I do is I wait for them to establish a new high and a new low. Then I wait. I wait to see where the opportunity exists. We get a short trade opportunity, which again is going to hit stops. But when we combine this on our smaller time frames, and this isn't even a good setup, I'm just using it as an example of high-low opportunity. We're using that now on our smaller time frames, but we're looking where the bigger opportunity lies for asymmetrical risk-reward. Now, this is the pound, but an example of even if you're just in that for the gray lines are Fridays, but we could be in on a trade on a Monday, Tuesday, Wednesday for 150 or more pips. An example here on the euro. Last week, the same scenario. We have a Monday, Tuesday, Wednesday. So again, Monday, Tuesday sets a high and a low. Wednesday, they extend the range down, but then we get our narrow range compressed day zero opportunity. So again, peak formation high, peak formation low, narrow range, low or high of the week, and then a market that goes into consolidation. So remember the basic pattern. Expand the range up top, expand the range on the bottom, go into consolidation and trend the market. But these are explosive moves. So again, on the euro, typically I look for a 50 pip box on the euro, the pound, and all the major pairs. If we go outside of that 50 pips, all that tells me now is that my high-low for that week is at least 75. Now, they may go and do a measured move of 150, which is sort of an average range for some of the majors. But this 75 pip high-low, as they expand the range down and we get our consolidation, now we're targeting 50 to 75 minimum. But these are explosive vertical moves. So again, a sizable trade setup opportunity. And this was the beginning of May. So again, day 1, day 2, day 3, at the beginning of a month, at the low of the day, the low of the week, and the low of the month for an explosive vertical move. Now, in some of these, you may choose to put a trailer on and leave some of those positions off and let them follow through if we're at the low of a month and there's an opportunity potentially maybe for a week or a 2-week move. Again, the 3-day cycle. So coming back to understanding my approach and what I'm looking for with those are scalable, duplicatable trade setups for me. High of the day, low of the day. High of the week, low of the week. High of the month, low of the month. When you combine those, even bigger potentially, but even just the high of the day, low of the day opportunities. I like to work from a previous day's high or low, but that 3-day cycle, there's a lot of variations. We'll go into those further in some coming videos, but you're not missing out on anything. Understand that once they have volume trapped and they're reversing the markets, they are not coming back because they have volume trapped. And that is why those markets will move fast and aggressively. The timing window is critical for stop hunts and trapping volume. So again, understand that the news calendar can be used. The weekly cycle, you'll see large moves sometimes and wonder how they could have been traded, but then you're missing possibly the understanding that the real trade hasn't happened yet and that they've just moved the market further or in one direction to get traders chasing it down low or chasing it up high because they're convinced that it's a trending market. So understand the other scenario is that this is a 15-minute chart, previous day's high and low, weekly high and low. When we're trading inside here, we're inside. So this is potentially your trapped volume. Now, there are opportunities in here, which is why I talk about taking money off the table. If you're in a 50 pip move in Asia or, if it's 25 and on the pound or the euro, take the 25. If you're at a weekly high or low, well, that's different. So again, they get volume in the market, they make a low, they make a high, they go inside, they hit stops, and then they go back in the direction that they initially were heading towards. So when I'm inside here, I'm very cautious, but when I get the opportunities at the high or low of the day, depending on how that sets up and where we're at in our Monday, Tuesday, Wednesday, Thursday, Friday cycle, those are opportunities that are scalable. And again, understand that as I've said, I'm looking to make money on the days that it's easy to make money on. So if I'm trading up in here and trying to guess which way it's going to go and I get in short and I load the boat, okay, I got lucky on this particular day, but maybe I went long here and I load the boat and it takes a lot of work to get 40 to 50 pips and boom, they come right back. This isn't exactly what I want to look for. I'm looking for something that's going to go vertical, and there's a reason why it's going to go vertical. Once they have volume trapped and they go to one of the extremes, that triggers other time frame traders into the market. They've got people trapped. They've got people trapped on the inside. There may be a news spike, whatever, but understanding when you're at the extremes, that's when the opportunities exist. FOMO is in your head. You aren't missing out. There are great trades every week. Regardless of what you've seen on a market move, there are plenty of trade opportunities on all the pairs. Understanding the instrument that you're trading and being patient, because the same thing's going to happen next week. It happens every week. It happens every day. Why? Because somebody has to lose. So study the highs and lows. Don't just blindly counter trend a market or jump into a trend because you see an engulfment or a pin hammer. Understand when and how a market may have the potential to move fast, explosive, and not come back. These are the setups that I wait for. They happen every week. They're scalable in size, and they're reproducible. And it's the nature of how markets work. It's going to happen next week. It's going to happen this week. It's going to happen today. So hopefully you got value from today's video, traders. Focus on your best trade setups. Understands which ones are scalable. Look at the 3-day cycle. Understand how that applies even on your daily time frames. There's opportunities at the beginning of every month. There's opportunities in the middle of the month. Same reason. It's set a high and a low, and then either a continuation or a reversal, but there's always a stop hunt. Same type of movement on a daily chart. You'll get 1, 2, 3. You'll get a 3-bar stop hunt. Could be 4 days, but it'll typically be a 1, 2, 3 type of setup. Keep it simple. Look for the best trade setups. Stay disciplined. Stay focused. Have a great trading session, and may the markets go with you.
It's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.